You're faced with a bittersweet dilemma. It's time to sell the business that you've been building for the past 4 decades. The bitterness comes from the fact that you know a considerable portion of the sale will be taken in the form of capital gains tax. At the sale price of $1 million, $240,000 will be claimed by the IRS. After looking for ways to minimize the large tax bill, your accountant finds a solution: the structured installment sale. Here's how it works. In a traditional sale, when an asset like a business is sold, the seller receives all the proceeds in one lump sum. Because of this, they are likely to be placed in a high tax bracket and lose a sizable portion of their hard-earned cash. In a structured installment sale, the seller gets payments over time instead of a lump sum. In order to avoid constructive receipt of the sale, a third party, like a highly regulated insurance company, is used. The buyer transfers funds to the insurance company, such as MetLife, which then sets up an annuity for the seller. This allows the seller to tailor the payment schedule to meet their financial needs and to optimize for tax efficiency. So, in your example, if you chose to receive the full amount in one lump sum, you will owe the IRS $240,000, leaving you with only $660,000 left. But you don't need all that money right now. You would like to plan for the future and have a steady stream of income for the next 10 years. You opt for the structured installment sale. This means you will get a monthly installment of $10,300 for 10 years. After accruing a 4.5% interest rate and subtracting all taxes, the total amount received reaches $1.1 million. By simply deferring your gains, you were able to save $460,000 in just 10 years. Perhaps you don't own a business. We can take a look at how utilizing a structured sale can be beneficial for homeowners. Tom and Linda had spent the last 30 years in a charming 4-bedroom house on the outskirts of a bustling city. With their children grown and the allure of a simpler, seaside lifestyle calling, they decided to downsize to a beachfront condo. Their home was a hot commodity in the real estate market and quickly fetched an offer for $950,000. Understanding the tax implications of such a sale, the Robinsons knew a 1031 exchange wouldn't apply in their case, as they were not reinvesting in another like-kind property but rather downsizing. Fortunately, since they had lived in the house as their primary residence for at least 2 of the last 5 years, they qualified to exclude $500,000 of the gain from the sale from being taxed. To manage the remaining $450,000 gain effectively and avoid a large tax hit, they opted for a structured installment sale. The buyer agreed to the plan and wrote the check to the insurance company, which created the annuity for Tom and Linda. As a result, Tom and Linda went from the 15% tax bracket down to 0%. If you find yourself facing a similar situation, consult with your tax expert or visit our site at installmentsaleplans.com for more information.